Hi, both. Thanks for joining us today on our Business Gurus channel, where we will be discussing key business topics to help students grasp the most important elements of their course in preparation for their exams and future career. Let's get started.
Welcome to the deep dive. So, our mission today, it's really focused on a critical challenge, I think, for anyone who relies on business data. Whether you're making investment choices, looking at competitors, maybe assessing a partner, you're looking at those published financial numbers to understand performance.
Yeah, exactly. And look, you have to look at them. Financial accounts are produced specifically to help people make decisions. But the catch is, if you take those final published figures as just objective, undeniable truth, well, you're starting off on the wrong foot, really. How useful they are depends entirely on recognizing the, let's say, built-in limitations.
Exactly. So this deep dive is all about moving past just, surface level number crunching. We're going to walk through the three fundamental limitations of that published financial information, and then hopefully arm you with four key analytical tools, quantitative, qualitative data, and trends that help you really analyze business health, not just sort of report on it.
Right. And if we kind of connect this to the bigger picture for a sec, I mean, we're drowning in information these days, right?
Yeah.
So your critical edge, it comes from a healthy skepticism. The moment you understand why the numbers might be bending or maybe even lying, you gain this huge analytical advantage over people who just read the headlines.
Okay, so let's unpack this first big limitation. It's the one that makes financial analysis sometimes feel more like an art than a science. Even when all the math adds up perfectly, the accounts are inherently, and then the source says this, open to interpretation.
Yeah, and what's really interesting there is the immediate consequence of that subjectivity. The source mentions lots of people can read it and they may all think different things.
Yeah.
And look, this isn't just some vague idea, it's like baked into the system. You could literally put the same balance sheet in front of five really experienced analysts, and because there are judgment calls required all through the reporting process, well, they might walk away with five pretty different takes on the company's value or its risks.
Hmm. But if these accounts are supposed to give, shareholders and creditors a clear, true picture, why haven't regulators just stamped out these judgment calls? Doesn't that seem like a failure of standardization?
It's really down to the unavoidable complexity of actual business.
Hmm.
Accounting isn't just adding up receipts, right? It forces management to make these forward-looking judgments that directly affect the results they report today. Take depreciation, for example. Classic one. Management has to decide the useful life of a machine. Is it 5 years? 10 years? Now, if they pick a shorter time frame, say 5 years, they report a higher depreciation expense. Now, that lowers this year's profit on paper. But that choice, which is purely an interpretation about the future, it makes current earnings look lower. But it could also inflate ratios like asset turnover, making the company seem maybe more efficient this year than it really is.
Wow, okay, that's a really powerful distinction. The judgment call itself changes the final number we see. And you mentioned inventory, too.
Precisely. Yeah, think about inventory valuation methods. So you've got CFO, first in, first out, versus LIFO, last in, first out. Now, if your costs for materials are going up, using FIFO makes your cost of goods sold look lower, which means your reported profits look higher. LIFO does the opposite. Now, both methods are perfectly legitimate under certain accounting rules, but they can give you a massively different bottom line. And that's purely based on an accounting choice and interpretation. And it fundamentally warps how comparable companies might look.
So, okay, to be a smart analyst, you actually need to spend less time just staring at that big net income number and maybe more time digging into the footnotes, the accounting policies section. This subjectivity, it's like you said, a built-in feature, maybe not a bug of the system.
That's the core hurdle,
Yeah,
absolutely.
yeah.
You have to investigate the policies driving the numbers, not just, look at the totals.
Right. And that takes us past subjectivity, sort of, into the next area of potential trouble, the unavoidable human factor. We've accepted interpretation creates these, let's call them legitimate differences. But now we hit actual, like, objective flaws. Limitation number two is that accounts are produced by humans, and because of that, they are open to human error.
Yeah, and this is where we just need a dose of realism, I think. We often imagine errors as, big dramatic fraud cases, but honestly, sometimes it's the tired accountant hitting the wrong key late at night or a simple mistake in a spreadsheet formula. We've seen it, right? Huge corporations have had to restate earnings, mistake cash by millions, even billions,
Yeah.
because of a simple input error. Or maybe just misclassifying one big transaction. Even with audits and checks, human fallibility means the numbers you're reading might just be, well, plain wrong.
And that risk, that accidental error risk, it gets compounded by the third limitation our analysis points out, systemic variance. So not only are the numbers potentially wrong by accident, but the source notes there are lots of ways of producing accounts, so they may vary from business to business.
hmm And this is where that interpretation problem we talked about first kind of crashes into this structural problem.
Mm.
So if company A uses FIFO for inventory, like we discussed, and
Yeah.
company B uses LIFO, and remember, that's a legitimate methodological difference. How can you confidently compare their profitability, say, line by line? You're comparing company A's apples with company B's oranges. Even if both fruits are perfectly fine, comparing them directly is potentially very misleading.
Okay, so let me see if I've got this right. If I'm trying to analyze two competitors, say, in the same industry, the combination of potential human mistakes in the data entry, plus these totally allowed differences in how they do things like different depreciation schedules or inventory methods, it means I absolutely cannot just assume their gross profit margins are directly comparable by pulling those two numbers off their income statements.
Exactly right. We can kind of synthesize limitations 2 and 3 there. The simple, maybe uncomfortable truth is that comparing two companies properly requires you, the critical thinker, the learner, to try normalize that data. You have to understand how each number was actually calculated to even attempt to level the playing field, which of course raises a really important question. If the basic data itself is this, well, wobbly, how do we actually rise above all that noise and make informed critical decisions?
That is the pivot point, isn't it? Okay. We acknowledge the data's flawed. It's interpretive, it's error prone, it's inconsistent from one business to the next. So now we need the right analytical vocabulary to deal with that reality. And this is where we turn to those four key terms provided in our analysis. They function like essential filters, really.
Yeah, I like that filters. We can frame these terms quantitative and qualitative, data and trends as your toolkit, your kit for turning these potentially misleading financial numbers into something robust, meaningful insight.
Okay, let's start with the first pair then, quantitative and qualitative. We've spent most of our time so far talking about the quantitative side, the numbers, right? The profit, the debt, the revenue, all measurable stuff. Why is the qualitative context so critical when we're trying to analyze performance?
Because the quantitative data, that's the output. But the qualitative context, that's the story behind the numbers. And sometimes it's actually the reason for an error or a strange result. Financial accounts give you the figures, sure, but understanding their limitations requires that qualitative background. What's management's philosophy? What were the specific market conditions that year? What were those methodology choices we just spent time on?
Can you give us a concrete application? Like, how does applying a qualitative filter actually change how you'd interpret a quantitative result?
Okay, sure. Imagine you see a quantitative result. A company posts a sudden, massive 50% jump in net profit this year. On the surface, quantitatively, that looks fantastic. Great data point. But then, the qualitative context, maybe from the footnotes or management discussion, reveals that jump was entirely because they sold off a really valuable piece of property, a factory maybe, that they'd held for ages. A one-off event. It won't happen again next year. The core business operations. They haven't actually improved at all. Now, if you only focused on that quantitative snapshot, you might assume sustainable growth. But with the qualitative filter applied, you realize that profit jump is mostly just noise. It's not a reliable indicator of future performance at all.
That distinction is absolutely crucial. Yeah. It could change an investment decision from, oh, buy now, to, hang on, proceed with extreme caution. Okay, now let's move to the second pairing. Data and trends. We're constantly flooded with data points, right? But the source makes a clear difference between a single piece of data and the overall trend.
Yes, and this is maybe the most practical tool for navigating all these errors and interpretation issues we've discussed. A single piece of data, that 1 year's 50% profit jump we just talked about,
Yeah.
or maybe a single quarter's debt ratio, it's highly susceptible to, well, all of it. Human error, weird economic conditions that month, a one-off accounting choice. It's just a snapshot in time.
And snapshots can be really misleading, can't they? Like a photo taken at just the wrong moment.
Exactly. But if you look at the trend, say, the profit margin over 5 years or the debt ratio over 10 years, you start to get a much more resilient, stable picture. Trends tend to smooth out the noise, that single accidental typo, the temporary blip in the market, even the impact of changing an accounting method 1 year.
So the overall pattern is far more reliable for trying to figure out future success.
Absolutely. Trends show you persistent behavior, long-term viability. If a company changed its depreciation method this year, yeah, that data point for this year will be distorted compared to last year. But if the overall 5-year trend for its cash flow generation is still positive and steady, well, that trend is much more reliable evidence of underlying health than the single number generated under the new, maybe less clear accounting policy. Prioritizing trends over isolated data points. That's how you leverage your analysis to look for genuine, persistent performance, not just momentary flashes.
That shift in focus is really powerful, actually. It moves the analyst from just sort of reading a report to actually building a much more comprehensive picture over time.
And using these terms, thinking about quantitative and qualitative, data versus trends, it helps you spot the difference between, say, a misleading number and a reliable long-term pattern. You're no longer just comparing numbers, you're comparing the methodologies, the context, the direction of travel.
Okay, let's try and bring this home then. We started this deep dive with the idea that published financial information isn't perfect objective truth, not by a long shot. We've established 3 core limitations. It's open to subjective interpretation through management choices. It's prone to unavoidable, sometimes simple human error.
Right.
And it's subject to these legitimate, business-specific variations in accounting methods that make comparisons tricky.
Exactly. And by arming yourself with the ability to pair that quantitative analysis with the essential qualitative context, and crucially, by prioritizing those robust long-term trends over the easily distorted single data points, well, you're now equipped, hopefully, to read financial information not as some kind of final verdict, but as a sophisticated starting point for real critical investigation.
And that knowledge, that approach, that's your competitive edge right there.
It really is. And speaking of that edge, maybe let's leave you, the listener, with a provocative thought that kind of ties all this together. Given that quantitative data is so open to interpretation and error, you have to be skeptical, right? So consider this. If you absolutely had to bet on a business's future success based on only one factor, would you choose a strong quantitative trend, say, consistent profit growth over the last 5 years? Or would you bet on excellent current qualitative data, like a brilliant new management team, explaining exactly why their future looks great, even if the recent numbers aren't stellar? Which one, trend or qualitative story, would give you the most reliable compass for long-term viability and why? That's the kind of question, I think, that separates the really informed analyst from the surface-level reader.
That's a great question to chew on. Excellent. Thank you for joining us for the deep dive. We'll catch you next time.
Thanks to both of you for joining us today. You've been listening to the Business Gurus. Let's now hand it over to you. What further questions do you have based on what we've discussed so far? Leave a comment and we'll get back to you right away. If you haven't already, hit that follow for more business tips.